You know that tap to pay for your morning coffee? It feels like absolute magic, doesn't it? But behind that super simple gesture, there's this whole hidden world of technology making some pretty critical decisions about your money. So today, we're going to pull back that curtain and see what's really going on.
Because that little bit of magic isn't just one thing. It's actually a choice you're making between totally different systems, and each one has its own set of rules for protecting or, maybe exposing your financial info.
And understanding that choice, that's the key part for you. Because the app you use to pay literally determines the rules, the security, and even the fundamental nature of your digital cash. It's a bigger deal than you might think.
Okay, so let's start our investigation with the tool that's probably right in your pocket, the digital wallet. What even is it really?
So at its most basic level, a digital wallet is just what it says here. It's a software app that holds your payment information. But its real job, its most important job, is to make a very, very complex process feel incredibly simple.
And that simplicity is the entire point. You can think of it like the dashboard of your car, right? You just see the speedometer and the fuel gauge, not all the complex engine parts and messy wiring underneath. That's exactly what this app does. It's a super user-friendly shield, and it hides all the messy mechanics of banks and payment networks to make it all just feel effortless.
But here's the twist. Behind that simple screen, not all wallets are built the same. They actually fall into two very different camps, and it's all based on one crucial difference: how they handle your money. So on one side, you've got your pass-through wallets, think Apple Pay or Google Wallet. You can just picture these as a really secure digital folder for the cards you already have. And then on the other side, you have stored value wallets like PayPal or Venmo, where you can actually hold a digital balance inside the app itself. Let's start by digging into how that pass-through model keeps you safe. Okay, the secret weapon for the pass-through model is this really clever process called tokenization. So when you add your card, the wallet doesn't just save your 16-digit number. Nope. Instead, it replaces it with a totally unique encrypted code. That's the token. So when you go to pay, the merchant only ever sees this disposable token. And that right there is the key benefit. It's huge. Because if that merchant ever gets hacked, the bad guys only get a useless token, not your real card number. Your actual bank account stays completely safe and sound. I mean, that is a massive deal for your financial safety. All right, now let's switch gears and talk about the stored value model. Instead of just passing information through, these services use something called e-money. Now, this isn't just a link to your bank account. It's an actual digital balance that you're holding with a company like PayPal. Legally speaking, it's a claim you have on them, and they're required to back up every dollar of your balance with real money in a separate, safe bank account. The biggest win here is for sending money to friends. I mean, we all do it. When you pay someone on the same platform, the money doesn't have to go slogging through the slow, old-school banking system. The company just adjusts the numbers in its own internal books. That's why it's so fast, it's instant, and it's often totally free. Okay, now this is really, really important. Holding a balance in one of these wallets is not the same thing as having money in a bank. These are payment tools, not savings accounts. Your funds usually aren't protected by government deposit insurance, and you're definitely not going to be earning any interest on that balance. But what if you want the convenience of a card without having to link it to a bank account at all? Well, that's where our third tool comes into play, the prepaid card. A prepaid card is basically the digital version of putting cash in an envelope. It's that simple. You load it up with a specific amount of money, and that's it. It has no connection to your bank account like a debit card, and you're not borrowing money like you do with a credit card. The whole process is incredibly straightforward. You load it, you spend it, and when that balance hits zero, the card just stops working. That's it, until you decide to add more money. And you know what? That simplicity is actually a really powerful feature. And here we see the classic trade-off. On the plus side, these cards are an absolute lifeline for people who might not have bank accounts. They're a fantastic tool for sticking to a budget, and they're super secure. A thief can only ever steal whatever balance is left on the card. But the downsides are real. You have to watch out for potential fees, and using one of these won't do anything to help you build a credit score. So we've looked at pass-through wallets, we've looked at stored value e-money, and now prepaid cards. Each one is a different tool, really, designed for a different purpose, with its own set of rules and its own protections. And that right there is the main takeaway. That seamless, magical tap is just the tip of the iceberg. And now you know the difference between a transaction that's protected by a disposable token and one that uses a stored e-money balance. And trust me, that's not just trivia. That's powerful knowledge for protecting your money.
So the next time you reach for your phone or a card to pay for something, you'll know exactly what's happening behind the scenes. And you can ask yourself, based on what I need, whether it's top-tier security or lightning-fast transfers to a friend, or just strict budget control, which of these tools truly belongs in my digital wallet?